Good morning, everybody. Today we're going to talk a little bit about depreciation deductions from your income tax. So if we purchase a building for $1 million, I like to keep these numbers round and easy. About $700,000 of it is going to be depreciable based on a 70-30 split between land and building. It's pretty much standard. It could be 80-20. We're just going to keep things easy for now. So under IRS code section 1250, which most people use, will allow you to deduct that $700,000 depreciation over a 39-year period, or about $18,000 a year. Let's assume you're making 10% on your money on your NOI, and you make $100,000 a year on your investment. You're only going to pay tax on $82,000, your taxable income. Now, here's what happens with cost segregation. So you come into a property, and again, you pay $1 million. Again, you have $700,000 of it. It's not land that you can deduct. But now, let's say there's an overly built electrical system in the property, or a heavy-duty HVAC system in the property, because maybe it's a medical use. Maybe there's x-ray machines, MRI machines, and other such things like that. Now, the IRS code, section 1245, allows you to accelerate that depreciation over 5, 7, and 15 years based on the items. So this costs money, though. You have to have a tax expert come in and do a cost segregation analysis. And generally, they get a percentage of the first year's savings in taxes. So let's take this for an example. Let's say they do the cost segregation analysis and they come up with $200,000 is deductible over 5 years. Okay, now that $200,000 would get you a $40,000 a year depreciation over 5 years. For the first 5 years now, you can't take it forever. And the other $500,000 that's left over would be deductible over the standard 39 years, and that would come out to about $12,800. So your depreciation is going to be $52,800 in your first 5 years. How's that transform into taxable? Well, instead of $100,000, you're going to take $52,000 off of that, and you're only going to pay tax on $48,000 taxable income. So you're going to pay tax on $48,000 even though you made $100,000. Now, standard, you're going to pay tax on $82,000. As you can tell, if you're in a 29% tax bracket, and you're maxed out on your deductions, this is going to make a significant difference to your annual tax flow the first 5 years you have that property. Now, it's not an end all, and not everybody should do this. Depends on your own financial structure. Depends how quick you're holding on to the property, when you're getting rid of the property. Is cash flow an issue? Is there another investment you need to roll this money into? Those are all great reasons to accelerate your depreciation, but you need to seek the advice of an income tax professional. And not all CPAs can do a cost segregation because it's very time consuming. But if you need help with it, I can direct you in the right direction. And hopefully this has helped you out, and it'll give you the opportunity to save a little money and make more investments and be more profitable. Thank you.